going all the way back for several years now, actually, the stock market has not outperformed gold. And added to that fact, that gold is now broken out versus the stock market. As an investor, you would have to ask yourself, well, why am I putting so much focus into the stock market when clearly the action is starting to take place elsewhere? Now, obviously, a lot of stocks in the stock market pay dividends and all that kind of stuff. So there's lots of reasons to hold stocks in the stock market. But if you have control over what's in your retirement fund, you need to start thinking about possibly starting to shift your focus towards precious metals and commodities.
You're watching Capital Cause. My name is Danny. It is June 25th, 2025, and my guests today are Patrick Kareem and Kevin Wadsworth from NorthStar BadCharts. We're going to look at a ton of charts today. We're going to analyze the market and see what's going on. Guys, thank you so much for coming on the show.
Hey, Danny, it's good to be back. How you doing?
Good. How's it going, everyone? So let's go ahead and dive right in, fellas. I'll start off with you, Patrick, since you're in the middle there. What do you think should be front and center for investors out there? What should be on their radar screen most prominently right now?
Look, it's like, I'll show you some charts there, but there's some big moves brewing, but there's also some conflicting data. Kevin and I, we like calling that weight of evidence. So you see a chart that looks it's going to be breaking out, but then let's say like the copper chart, but then you get some other charts like the 10-year minus a 2-year yield, the rock still going upwards. You see the 2-year yield starting to falter. Oil it looked great like beginning of last week, and then after that it just fell apart. You could insert your favorite narrative why it fell apart, but it's having a hard time, like just like that, right? And again, it's something often we do, Kevin and I, there. It's a multi-time frame analysis. So sometimes you have the shorter term that looks great. And that's also good for your viewers, Danny. Like always ask what time frame you're looking at. But then after that, if the daily could look good, but after that, by the end of the month and the last 3-4 days, I've seen it so many times. And after that, the price just crumbles. No breakout, false breakdown. And the guys who got in too early, then they're trapped. And then, they get all upset. So I could show you one chart. There's a good setup, guys. Okay, that's happening right now. It's in the copper space. I don't know if you guys, if your guys are interested. And remember, guys, a potential chart setup that's just what it is. It's a potential chart setup. It's not a confirmed breakout. It's not anything of the sorts. It's just a potential.
And how meaningful is copper to the economy? You mean Dr. Copper is cliche by now, but does a breakout in copper mean anything substantial, have any meaningful impact for the economy?
Yes. Well, copper, you could see copper if you measure like the business cycle and you see like there's a recession. Sometimes copper could flare up, and I have an example. Okay, I'll show you the copper chart. I was going to show you the copper miners, but I'll show you the copper chart just to, and here I'll overlay the recessions right there. All right, it's loading. I'll go on the monthly chart. You could have copper rocketing upwards during a recession. Okay, here it is. Okay, here's the 2001 recession, guys. So copper was already breaking down, barely taking off back in 2001. Just like gold and silver were completing bear eras and bear markets heading into the 2001 capital rotation event. And then after that, you had the recession here. So that's the economy doing bad. Copper went down. But then after that here, also you had copper breaking out in the first few months of the GFC. Copper actually went up, and the oil went up even higher. And I believe silver also went up higher. But then after that, copper got taken down, and then bottom before the end of the recession. Look at that. After that, before the end of the recession, copper already went up. So yes, the Dr. Copper has merit, but depending if you're an uptrend or not, the impact on the copper chart could be much less than expected. Here's a copper chart. Look at that copper chart, guys. You did have a breakout here. Hey, Kevin, look on the monthly chart there. We kind of did have a breakout right here in that area. We did breakout back test. Will that back test survive and continue breaking out? we'll have to test. But if you want to be objective about this, on the hard time frame, higher lows, higher highs, it is an uptrend. So until copper starts breaking down below its next rising trend line, below the 1 year moving average, the bias is upwards. Are we in a situation here where we live in fear and there's a recession and brings it all down? Look, it's possible. I could scare you guys a little bit there. I'll show you just my last tangent on this. I'll show you guys the two-year yield chart. And look at that. The 2 year yield chart, guys, remove drawings. It likes going down. The Fed fund rate tracks this also. When you zoom out. The 2 year yields going down, recession goes up. Look at that. The GFC, the 2 year yields, the short-term inflation expectations are starting going down, break down. Guess what? We get recessions are more likely here. Here also we had the recession here, the COVID one. But look what's happening again, guys. My goodness, it's like I'm going to zoom in here for you guys. It's on a sagging wedge. Sometimes this could break upwards, but it's just if that doesn't manage to break out there, it's like just going to vomit downwards. And that is, if you combine that with the 10-year yield minus a 2 year yield, look, keep going up. Look at the recessions. Look at that when the 10-year minus the 2. So the long-term expectations stay steady or go up, or they could go down, but they're going down less than the 2 year yield, the short-term expectations. Along the way here, you get a recession. And I could have overlaid the unemployment chart, skyrocketing, initial claims skyrocketing. Gold versus SPX, the outperformance of gold versus SPX goes up at these moments, goes up. The miners, gold, silver miners, they go up. Look at that. Kevin showcased this a lot of times here. Here's the GFC one going up. Look, we're at risk. Because this thing is not trending downwards, going upwards, we're in a situation like, you guys remember the Price is Right one, where the guys, he goes up with the pickaxe, and if they don't answer the price correctly, then it just, you run out of price, and then it just falls. We're that type of situation. Where are we on that rising mountain, like on the yodel game? And when is the rug pull going to happen,
Yeah, I'll very good questions there to ponder, Patrick. Kevin, anything else you'd like to add?
Yeah, sure. Well, I'll just share my screen with you and just talk you through what I'm seeing. Okay, if I've got the screen sharing set up right there, you're looking at the gold versus Dow semestrial chart. So what I really want to just sort of emphasize for everybody is, talking about what's happening in the short term is one thing, but we need to step back and just remind ourselves what's happening in the big picture. And the big picture is charts like this, which is gold versus the Dow Jones. So when the chart's going up, gold is outperforming, and when the chart's moving down, the Dow Jones is outperforming gold. Now, we get these rotations that happen on a regular basis, and they rotate in both directions. The red arrows show the rotations downwards, and the green arrows show the rotations upwards. So when you get the green upward rotations, that is gold entering a significant period of outperformance versus the stock markets, and in this case, the Dow Jones. Now, if we just use a little bit of technical analysis here, what we can say is that when the chart breaks above the 4 year moving average and above critical resistance levels, and they can be a combination of slightly declining lines and probably the more important horizontal resistance lines, when we break out above those, that's giving us a much higher degree of confidence that gold is going to move on into a period of outperformance versus the stock markets. Now this is a 6 monthly chart, by the way, and we're coming up on Monday with the 6 monthly close, the semestrial close. So I'm not sure when this is going out, but Monday is going to be the 6 monthly close. So whenever you're looking at this,
and that's the second most important close of the year, right?
Second most important close of the year after the December close. So in terms of long-term trend, if we get a 6 monthly close above this horizontal resistance line, then it's telling us something. And the more convincing the close, the better. If it doesn't, then of course, what we're left with is a close that is still above the downtrending resistance line, but that is still prone to a back test before moving higher. So long story short, the evidence is strongly suggesting that gold is in a strong period of outperformance, and that's summarized by this capital rotation chart. So gold is in a bull market versus money supply, the US dollar index, CPI, PPI, currency in circulation, the S&P equal weighted, the New York Composite, the Dow Jones, the Wilshire, the Russell, the S&P and the NASDAQ. Gold has broken out versus both of those. So these green boxes now could just about be shaded in red because there has been a significant breakout for gold versus the stock market and versus NASDAQ. Now, there's one crucial missing piece to this jigsaw puzzle, and that's the stock market, because the reason these ratio charts have been trending upwards so strongly, with gold outperforming everything, is because gold has pretty much doubled from $1,600 to, well, $3,500 at one point. We broke out through the 2000 level, and gold was sending a massive message. Silver is playing a little bit of catch up, and platinum and palladium are starting to respond. Copper, as you've heard, uranium as well. The uranium charts are looking very, very interesting at the moment. So what I'm saying here is that gold has led on this occasion, and we've seen a range of commodities at various points sort of surging to the upside. But this is incredibly early in the process. As you just saw, gold is barely breaking out versus the NASDAQ at the moment. And if you look at silver versus the NASDAQ and silver versus the S&P, you get the same picture. This is incredibly early, so there's no need to have any fear of missing out. But the S&P, I've got the blue and the red comparisons with 2008 and 2000, and we're already somewhat above both of those scenarios. So some kind of multi-month period, perhaps a couple of months now, where the S&P does particularly well, and cryptocurrencies, I should mention Bitcoin, for example, as well, is breaking out quite strongly here towards the 114,000 area, which is critical resistance, going all the way back to those previous tops that we saw back in 2021, 2022 there. So that's Bitcoin rising. So Bitcoin is risk on. The S&P, of course, is rising now. If we break out above around about 114 on Bitcoin, that's going to be another piece of evidence that we're looking at a risk on period where we may well, or we will at that stage, see a sort of finishing flourish to the crypto bull market with things like, for example, XRP outperforming in the next stage. You can see this ratio chart here where XRP has broken out versus Bitcoin. It has back tested the breakout and is beautifully positioned for a potential rapid upside move where the altcoins outperform. Now, this is the altcoin versus Bitcoin chart, which is actually broken down to the downside, and this needs to become a false breakdown. So what I'm saying at the moment is this: it's not a done deal, and there's no need to front run this, because if this total 2 versus Bitcoin chart, altcoins versus Bitcoin, if and when it starts to move upwards, we'll have plenty of notice. We'll have 2-3 weeks worth of notice that it's going to move upwards significantly. At that point, you can take your positions in the altcoins and benefit greatly from what would be a sort of very euphoric sort of finish to this particular cryptocurrency bull run. But until Bitcoin gets above 114 convincingly, then all of that is it's just a potential scenario. As I say, at the moment, it's not a done deal, but there are some signs there. And also gold, just before I finish here, just finally, gold itself is very, very stretched from its 3-year moving average. If you look at the green line down here, that's the 3-year moving average. Mm-hmm. And gold price has just about reached the 3,500, 3,600 level that I'd anticipated that it would do before it comes back for a major back test of that breakout before accelerating higher. So, there are reasons to think that gold may well pull back here. There are reasons to think that the stock market and Bitcoin are well positioned for some sort of breakout move and sort of flourishing finish to what has been so far a little bit of a disappointing bull run for Bitcoin. So that's how I'm seeing things at the moment, and we're poised and ready to take advantage of that. And just if you only remember one thing from all of this, It's that we are so early in the precious metals bull era at the moment that there's no need to panic and think that you've missed the boat, because when you look at things like the miners, GDX and so on, they haven't even broken out versus the stock market yet. They haven't broken out versus gold. So no matter what you're hearing on social media about about mining companies and gold miners and silver miners, just kind of zone out of that, because they haven't even broken out versus the metal yet. And that is one of the very early crucial things that must happen before you're confidently taking positions in a big way in precious metals miners.
Okay, so this is the backdrop this is the charts. Bitcoin could break out, even semiconductors, XSD, but this is the backdrop. Remember that 10 minus 2-year yield chart, or it tracks unemployment rate, all that. The generational, or the most important lower risk entry points for the stock market is after the 10 minus the 2 peaks, after jobless claims peak, after the unemployment rate peaks and starts unwinding. That's when people think, oh no, the stock, because what do you think of people going to say when the
unemployment? Can you guys pull it up while?
Oh yeah, I'll do it.
Just so the audience can see what you're talking about.
I was doing it with my hands, like the Lebanese way, but I guess some people might not appreciate that. Hold on, okay, I'll share. Here you go. So I'll put here the initial the unemployment rate, because what do you think people are going to say when the unemployment rate's 10%, right? Remember COVID? Oh, it's the end of the world, right? Look at the employment rate; it's so high. Like, people could only see darkness in the darkness. They have a hard time seeing the light. So if I overlay here the SPX new price scale, let me remove this here, and I'll put log scale. The low risk entry point, let's say I go here all the way, let's start at 2000 here. Stock market goes down, unemployment rate goes up. And look at the bottom here. The bottom is going to be in close proximity here. Look at that. Peak unemployment, guess what? You're starting to get a breakout here for the and it's going to be hard to play that, because you're going to say, hey, the employment's going up, but you're starting to break out. Look at here, the 2008 GFC. It plays over and over again. I'm going to move this dashed line here. Look at that. Peak unemployment, guess what's happening to the price? It's starting to break out, right? So look where we are now. So I'm asking you, Danny, or your viewers, ask yourself honestly, is the unemployment rate, to have a true resumption of a bull market, you would need the unemployment rate to start doing that, Danny, start going back down from here. Mm-hmm. And that would be, well, somebody's calling you.
And sorry, I did have to take that. Just bear with me a moment.
Okay. So that would be if ever the unemployment rate starts turning back down here, that means the economy is doing fine again, and the stock market will keep going up and up and up and above here. So now you got to ask yourself, when is this unemployment rate going to peak? Like, is it is going to keep going up, and then after that, once it's high, then you get the bottom in the stock market. But the stock market has not even started turning down again, right? So if you want to remove all that,
yeah, but I'm looking at those two charts in conjunction with one another, and you see these waves of unemployment over the course of history, but the stock market by and large just continues to move on up.
Yes, exactly, because the unemployment rate is an oscillator. So it's going to range from whatever 0 to 8 or 10%. But the SPX, it compounds the returns, right? So you're going to have sequences where they track together, but the over longer periods of time, the SPX will go up higher during those. Look, during here, let's say here the 1992 unwind. See the unwind of the unemployment rate. The stock market just like outpaced that unwind, right? It's not a highly return correlation. It's not going to be high, but from the analysis point of peak unemployment often coincides with important lows in the stock market. Yes, that you can make the case for that, right?
Yeah, so, but how strong do you think the correlation is between the two?
It's not statistically strong there. It's not going to be something that's going to make you, unemployment rate going up, so the correlation, the trend can be down. It's more this is more a turning point, like peripheral, like see tops.
Right.
unemployment starts going up, the stock market started going down. With unemployment starting to go up like that, you would have expected the stock market to already have started going down here. Because you see here, look at the unemployment here starting up. It even starting turning up, topping the market. But now the employment's going up, but the stock market is not turning down yet. It's just not. So you gotta, then you have the gold, the gold to SPX chart and all that. I'll just show you guys the remove indicators. Just the stock market chart. Let's look at that one for a few seconds. There's no,
and this is SPX, right? The S&P?
the stock market. Look, there's no breakdown yet. There's none. If you want to be truly objective about it, until you get some type of breakdown, back test, here's the .com bubble, like until you start getting stuff like that. What do you want me to tell you? This is a nut trend, right? There's no, yes, here it went below, but look, it closed the month back above. So you're still in that trend right here. So you can play that. Here's the the semiconductors.
But what if you hold the S&P relative to gold or the M2 money supply? Then it's a different story, right? Because
that's a different story.
It's a
different story, and you this is where it comes down to being aware of cross-market correlations, because you can look at the S&P chart and you can spend a lot of time analyzing it, but if you're aware of the fact that going all the way back for several years now, actually, the stock market has not outperformed gold, and added to that fact that gold is now broken out versus the stock market, as an investor, you would have to ask yourself, well, why am I putting so much focus into the stock market when clearly the action is starting to take place elsewhere? Now, obviously, a lot of stocks in the stock market pay dividends and all that kind of stuff. So there's lots of reasons to hold stocks in the stock market. But if you have control over what's in your retirement fund, you need to start thinking about possibly starting to shift your focus towards precious metals and commodities. I mean, not everybody can necessarily pick and choose which stocks are in their 401ks or whatever you call them in your part of the world where you're living. But if you do have some kind of control over your investments, then at the very least, you should be, in my view anyway, seriously considering allocating some of your wealth to the horse that's winning the race. And if the stock market hasn't outperformed gold for many years, which it hasn't, when you look at that ratio chart of gold versus the S&P, and it's breaking to the upside, and gold is breaking out versus all of these other things, then surely it makes some sense as an investor and as a trader to start paying attention to that. Something that you should also need to be aware of is that if and when the stock market does roll over, and there's no need to kind of constantly obsess about when the stock market is going to break down. It doesn't matter. It could be next week, next month, or next year. All I'm interested in as an investor is knowing when it happens. I don't care when it is, because in the meantime, I'm investing in something that is outperforming the stock market, cryptocurrencies, XRP, Sol, whatever it happens to be, Ethereum. I would always be investing in something that's outperforming the stock market. But the point that I'm trying to get to here is that it doesn't matter what people say. When's it going to happen? When's it going to happen? Who cares? I don't care. I'm not interested in
we know why, Kevin.
That tells me when it happens.
You know why they care? Because they're holding a bunch of SPX and they want to know. They don't have the asset that's outperforming SPX, so they're afraid.
Well, even if you're holding the SPX, as long as you're aware of where that line is on the chart that you just showed, and it's around about 5,500. That support line is somewhere around about 5,500 at the moment. So, assuming you've been in the stock market for a number of years and you're well in the profit with your stock market holdings, you just need to be aware of when it breaks that support level, because from that point onwards, the odds are high that you're going to have probably a lost decade. Gold is telling us that should the S&P break below that support line, that there is a high probability that it's going to take a decade to get back to where it is now. Just think about that for a moment. 10 years to get back to where it is now. You can exit at that 5,500 level when you get a monthly close below it, and take those funds and put them into whatever. It could be, commodity related stocks. It could be energy related stocks, oil stocks, physical gold, silver. And instead of watching your portfolio decline by another 30, 35%, 40%, instead of that, you're watching your portfolio double, and then stock market breaks out again versus gold. and you move your assets into the stock market again. So you're constantly cushioning the downside and constantly maximizing the upside just by being aware of where the support line is and how those ratio charts are.
That's why that line is important right now on the SPX, because of all the other things that are happening. The unemployment rate, the 10 minus the 2, the 2-year yield starting to turn down, gold breaking out versus SPX, because a breakdown of that rising trend line in the SPX happens with all the other elements. Remember that matrix Kevin showed you there? Because all the other check marks are there, guess what? We have a high confidence level. The probabilities are that we're a capital rotation event. So it will not be just a random 5, 15, 20% correction in the stock market. It should be a 40, 50% correction that stretches out over years. And after that, after it rallies back upwards, it gets another rug pull, right? 2001, 2008. In the 1960s, 70s, the SPX or the Dow there, it went sideways. It had 3 or 4 bear markets, 30%, 40%, 50%. It was crazy there, that sideways grind in the 70s. Like, you could have just held oil and,
And the fact that you're starting to see these altcoins begin to outperform Bitcoin, that tells you that you're most likely at the end stage of this stock market boom, right? Because once you start having once you start having capital being allocated further and further out the risk curve, that denotes that you're just trying to find the last piece of, they're trying to get as much juice out of this thing as possible. So they're willing to take more risk by going further out the risk curve.
Well, that's exactly what happens with mining stocks, of course. You're starting off with the metal going up, then you move to the major large cap mining companies, gold mining, and then that moves into silver, and you start to see the SIL ETF outperforming GDX. So the silver miners outperforming the gold miners. Then you start to see SILJ outperforming SIL, so the silver juniors outperforming the silver majors. And that's exactly what you just described. So the same thing happens in all asset classes during a bull cycle. The bull starts in the uranium sector with Cameco. Cameco is the market leader, and off it goes. And you've got other companies like, off the top of my head, I don't know, Anfield Energy or whatever, who are still languishing at bear market lows. And in the later stages of the bull market, when everybody believes it and it's blindingly obvious, and Cameco has gone up by 6x, then people are like, wow, okay, I'm going to buy this junior uranium miner that doesn't even have an operating mine. Starts with a value of 1 cent and ends up with a value of $1, and I've done a 99 bagger, so that's how bull markets end. That's the euphoric stage, and that's the kind of psychology of it. That's the whole psychology of a market.
So look at this chart, guys. I'm showing my screen there. Look at this is a silver versus the stock market. We know gold, is doing well versus the stock market. It's been, but even silver, gold's underperforming. Everybody likes picking on silver. Even the stock market is starting to lose steam. Look at that. It's above its 3-year 36-month moving average versus silver starting to go upwards. It's following in gold's footsteps. And I'll ask people, identify to me, where are the blow off tops for silver? The end game moves for anomaly in silver. I could have put the 1980s one here, but look, they happen when this trends for 8 years, 10 years upwards, and then we get a blow off top in silver outperforming SPX. And then after that, it could falter or continue upwards. Now it faltered. Look where we are now. We haven't even started yet. This is crazy. This is like, sometimes you're so early, you think it's almost over, nothing's going to happen. Guys, the true mind-boggling moves there of silver or the stock market going down 50, 60, 80, or 90% price in silver, right? I think the NASDAQ lost 90% of value from 2001 to 2011, right? It happened once you get an uptrend, right? Higher lows, we're doing that. Now we're going to maybe do a higher high eventually here. And after that, a higher high from a further away high, which is even more meaningful. And then what you got this trend there going upwards. It won't. So you look at that, Danny, and you say, like, people putting pressure, like, I have to pull the trigger. And oh my goodness, it's like you're so early.
Silver at $50, silver at $60 is nothing. It's just the very, very start. Silver's a recovery metal. Silver won't go crazy until the stock market has fallen 30, 40% towards its probable 50% decline, if we're talking about the S&P. So when the S&P breaks that 5,500 level or wherever it is, a few months from now or whenever it breaks down, it's you have to watch for the stock market dropping, watch for the stock market bear market, and watch for silver starting to break out, because you can say with a very high degree of confidence at that point that silver is going to go nuts. Silver's a recovery metal. As the stock market bottoms and starts to go up again, silver will double. It'll double again. It'll double. It's done this time after time. Silver, outperforms. Gold outperforms, platinum, palladium, but silver especially outperforms during its bull run pretty much everything. So if you're running around trying to find mining companies and it's all getting too much for you, just invest in silver, whether it's physical silver or you use one of the online digital companies for silver. You can double, triple, quadruple, 5x, 6x your initial investment in silver just by observing the breakout when the stock market is at a very low level. So that's a simple formula for making a lot of money over the next several years.
Now, throughout the course of the interview, you guys mentioned the other yellow metal, uranium. I'm curious to get your thoughts on some of the recent moves in uranium. Do you think, how does uranium look like to you right now? Because we've had a very long slog in a uranium bear market, or bear market since 2022 or so. How do you view the current price action in uranium? Are we starting to see a reversal? Uranium stocks are silently breaking out into a new bull market after a lull since 2022, and Capital Cosm viewers can get ahead with Uranium Insider, the only uranium investing newsletter out there. Unlock a 40-plus page monthly report with elite stock picks, daily market videos, real-time bulletins, exclusive webinars with experts like Justin Hune, and 5+ years of archived research. With supply shortages, soaring nuclear demand, now is the time to act. Uranium Insider Pro's 379.9% return since 2019 crushes ETFs. Exclusively for Capital Cosm viewers, save $50 on the quarterly plan, now $197, or $300 on the annual plan, just $497. It's a limited time only, so be sure to click on the special link in the description or the pinned comment.
Okay, well, I've got the uranium chart on the screen for you there, and this is the spot price of uranium, the metal, and you can see that we hit. So I put this chart out there around about 2020, about 5 years ago, after we started to get some evidence of this geometric arc formation and the price breaking out above the moving averages, resistance lines, and the Ichimoku cloud here, this red and green cloud structure. And that gave us an arc target area up here in the top right-hand corner, which we hit back in, last year. And trying to find the support levels for the price of uranium, it appears that the price is bouncing off the 3-year moving average and this nearby sort of shorter term support line. There's a longer term support line that's sort of lower down near the Ichimoku cloud itself, and I had thought that we might come back down to around about the $60 level to sort of test that, but it seems as though the market is showing a lot of strength at this point here, so it may well be that we've put in an important low here. So the price of uranium, the spot metal price, does look as though it wants to move back towards the $100 area. Whether it starts to advance rapidly beyond that, we'll just have to wait and see. But in terms of the miners, and if we look at the URA chart, I'll just take a look at URA, which is the uranium, one of the uranium ETFs. This chart has served us very well actually over the last 5 years. We put in a low point, the COVID low here back in 2020, which created this outer geometric arc. And you sometimes get these concentric patterns in technical analysis. The last line of defense here really was the Ichimoku cloud, this green splodge here, with a certain amount of sort of horizontal support in this zone. And fortunately for anybody invested in uranium, that price level at around about $21, $22 held firm, and we're now up at sort of $38. The targets are shown there. We've got a $50 to $65 sort of interim target and a possible later target up above $100 there for the URA ETF. So we're talking about potential to to see the mining stocks sort of double or triple from here as a whole. And given the fact that this is just a geometric arc, what happens when we hit the right-hand sort of portion of this arc here remains to be seen, whether we consolidate or whether we just continue to strongly move upwards. But again, if you do the ratio charts for uranium versus gold, and this is just, to put it in simple terms, this is uranium priced in gold. So it's the URA chart priced in gold. So if I do that for you, XAU USD, and we price uranium in gold, you can see what we've got here is getting pretty interesting now, because we broke out, we formed a nice consolidation pattern, and we had a bit of a panic with this breakdown here, which is now looking very much like a false breakdown. Now, in the world of technical analysis, when you get a false breakdown like that, it quite often, very often, means that you're going to see a very rapid and quite violent upside reaction following that false breakdown. So on the at face value, what it's sort of suggesting is the most likely outcome is a sort of a rapid upside move through horizontal resistance, with the uranium miners strongly outperforming gold. Now, just the caveat on that is we've got some resistance first, the 3-year moving average, the cloud itself, and this sort of area of resistance. But should we punch through that area of resistance, then I think we're going to have a high probability of a very rapid sort of upside move. And if I just use the measuring tool here to show you how much the uranium miners could outperform gold from that horizontal resistance level, you're talking about 400%.
Wow.
So if we were to see a return to those ratios for uranium miners versus gold, and we know that gold is going to be in a bull market during this time frame, 2027, 2028, 2029. So gold is likely to be moving upwards from where it is now. Then if the uranium miners are outperforming it by 400%, then that really starts to get very interesting. So the thing I would then do as an analyst, and what we do for our website members, is we start to compare uranium miners to silver miners, because we're also expecting in a precious metals bull era for the silver miners to do exceedingly well. So you would be continually comparing the gold and silver miners with the uranium miners, and you'd be able to pick which of those markets is going to be the most advantageous for you in terms of high returns. So ratio analysis is very powerful. Looking at the price is one thing, but it doesn't tell you if you're riding the fastest horse in the race. The horse is going around the circuit and it's heading towards the finish line, but if everything else is going past it, you don't want to be on that horse. You don't want to be on the S&P horse. You want to be on the gold horse or the uranium horse or the silver horse. So you can jump very quickly between these assets during a bull, during their bull phases, and that's what we use the ratio charts for. But yeah, just to summarize, uranium miners look particularly strong at the moment. We've mentioned copper miners and we've mentioned silver miners, but the amount of potential for uranium is huge.
So you would say we're still early in the uranium game.
Yeah.
Very early.
Yeah, and it's going to get only better after. It's good now, but it's going to get even better after the stock market to do a bottom in a bear market, because everybody loves a stock SPX at bottoms. Everybody loves it, but because after that on the recovery, it just fuels rocket fuel for a lot of stuff. That's
the uranium miners versus the S&P.
Oh my goodness, Kev, look at that! Wow.
If I get rid of all of the noise on the chart and just do this for you.
Well, you know what? That chart's brilliant, but put Cameco and you'll see that Cameco already broke out versus SPX there.
Cameco's at all-time highs too.
Yeah, it's like Cameco. It's like the flagship. Nobody wants to play it for some reason, but it's the best performing one out there, like forever. It's like, look at that beautiful uptrend. I could let Kevin do the narration, but what I'm looking at is at the bottom. Look at the stock RSI. It's just trying to cross over, so it's not even stretched yet. Look at the stock RSI just bottoming, double bottom at the bottom, and it's crazy there. Look at that. That's
Cameco relative to the S&P.
Yeah, and look at Cameco versus the S&P. It started going up before the S&P. Like, look back in the 2000s. There, it did great there. It's so it's like the stock market just hasn't rolled over yet. It's like you have the symptoms. If somebody would show me all the symptoms and not show me the SPX chart, but I'm allowed to see the ratio charts of everything, like versus SPX, gold versus everything. I look at everything, the yields, all that. And my guess would to tell you, well, of course the SPX is starting to be in the bear market, but it's not. It's just not yet. It's like that's why you got to always, even if you have a theory, a thesis, and you want to project that, and you want to force the SPX to go down, you can't. You got to be, objective with the truth. But the truth is also that even if the SPX is going up, you would have been much better to own Cameco since 2020 there, or 21 when it broke out there. You could have just held your Cameco instead of your SPX shares, and you're golden.
So Cameco has already outperformed the S&P by about 370%.
Yeah.
From here to this major resistance line is another 130% of outperformance. Now that could, of course, be a combination of the S&P falling. So if the S&P shows some relative strength from here and doesn't break down, then you could say that Cameco is going to increase by at least 130% from here. But if the S&P starts to decline, then Cameco, although going up, might not be as much as 130%.
And is Cameco, would you say Cameco is a leading indicator for the space? So if we're starting to see, if we've been seeing this massive outperformance by Cameco over the course of the last several years, should we not anticipate some of this capital beginning to flow into some of the other producers, maybe even the developers as well?
Yeah. So the uranium space is a real sort of mixed bag of potential, and some good-looking charts and some bad-looking charts. And we've got Alligator Energy there, which is below the moving averages, below the Ichimoku cloud. It's had a serious pullback there after its initial bull market move. I mean, you can scroll through these, and that's Anfield Energy that I mentioned earlier on, still languishing down near its bear market lows, but has clear potential for a big upside move. Some of these companies like Boss Energy have done very, very well. Yes. Some of the smaller ones like Aura Energy, saw there, not even broken out yet. So Boss, great. Cameco, great. Canalaska, looking pretty good. We've got CGN Mining, again, looking pretty good. Centrus Energy, looking very good. Above moving averages, above the Ichimoku cloud, heading towards the ARC target. Deep Yellow also looks pretty good, above the moving averages, above the Ichimoku cloud. Denison Mines, Elevate Uranium. Elevate Uranium, not above its moving averages or the Ichimoku cloud yet. It's just one of the charts that I happen to like the look of, and I think it has quite a lot of potential. Encore Energy, another chart with a good deal of potential, but still below the key technical indicators. So there's a real mixed bag there. You can work your way through the list, and there are some good ones and some not so good ones.
You have to be careful because, Danny, I know people, the mindset, I'm putting myself in the seat of your viewers, and because imagine Cameco could end its run, and your miners that you were hoping that would catch up to Cameco, they get the rug pulled because it's the end of the bull market. You know what I mean? I'm not saying that's what's happening, but often people start betting on the more and more risky stuff, like whatever, these micro caps, but sometimes they start so late, there's just not enough time for them to do any type of catch.
Yeah, on a chart like this area here is risky because the price is not yet through the moving averages.
What is that chart specifically?
This is Encore Energy. Okay, so
it's a NASDAQ listed one. It's one of the few.
NASDAQ listed. It's nearly $500 million, so it's kind of
small,
relatively small.
Yeah.
So, but ignoring the market cap, this, just looking at the chart structure, this area here is risky. But once you get above that horizontal resistance line, that big black line there, you'll be above the moving averages, above the Ichimoku cloud, above horizontal resistance, and then there's a much higher likelihood that you're actually going to reach wherever you happen to think your profit limit is, and you can calculate that from all sorts of different techniques. But what I'm saying is you're much higher probability of having a successful trade if you're above the moving averages, the cloud, and resistance. Now, clearly, you've got to watch the price go up just to get to that breakout point. But do you take the risk down here somewhere that the whole thing's going to reverse and you're just going to end up lower than you started? Or do you wait for a higher probability play when it breaks out through the horizontal resistance? That's clearly a matter of personal choice and personal sort of risk appetite. But just being aware that the risk is much higher down here than it is up here is the point I'm making.
Understood. Well, I think that pretty much covers everything I had in store for you guys. But if there's anything you'd like to talk about that we didn't get into, the floor is yours. Otherwise, we can wrap this thing up.
I think we've covered quite a lot of ground there. So that's probably enough. There's so much going on. It's hard to know where to look in the markets at the moment. But just remember those key points. The big picture hasn't changed. Capital rotation process is ongoing. The stock market and cryptocurrencies have an opportunity here to blast higher for a period of time, and if and when they break down, that's the time to react and kind of cut those positions and look more seriously at the capital rotation process.
That's right.
All right.
Seek refuge in the charts, guys. Don't get bamboozled by the war, no war, inflation, no tariff. Don't get involved in that. Look at the charts. You'll breathe easier. You'll see, I'm in an uptrend. I have the chances are with me, and you'll sleep much better at night than every morning waking up. Did they close the strait? Is Iran closing the oil? What's going to happen to this? Are they going to sell the strategic? All that stuff, guys. All that emotionally draining, whipsawing stuff that's out of your control. Throw that in the garbage, or at least if you listen to it with a grain of salt. But just look at the charts for the truth.
All right. For people who want to see more of your work, guys, I think you've got NorthStarBadCharts.com for your website, but I know you guys have separate Twitter accounts. Patrick, where can people find you if they want to hear more from you?
BadCharts1 on X.
And Kevin?
Yeah, also on X at NorthStar Charts.
All right. Well, guys, thank you so much for coming on. Guys, check out NorthStarBadCharts.com for Kevin and Patrick's website. Lots of great stuff in there. And if you got value out of this, podcast, drop a like and comment. Go Pat, go Kevin, go in the comments section. Let me know what you guys thought. If you disagreed with anything, that's fine too. But let me know what you disagreed on specifically, because I do indeed read the comments. Also, hit that subscribe button to not miss another episode. And liking, subscribing, commenting, doing all the YouTube stuff really does go a long way in pushing this channel and this video up in the algorithm. So if you want to spread this message loud and wide, or loud and far, I think is the saying, then hit that like and subscribe. Also, check us out on Substack. It's capitalcosm.substack.com, where you can get early access, ad-free versions, and uncensored versions of all my stuff, as well as the ability to ask questions to any and all my guests moving forward. You also get the chance to make guest recommendations as well. So link is down below, capitalcosm.substack.com. And yeah, thank you guys for watching. I'll see you later. Bye.